Good day, class. Welcome to the fourth session. In this session, we will look at how to analyze an income and expenditure statement. Let's start off by looking at the difference between assets and liabilities. Assets put money in your pocket, whereas liabilities take out money from your pocket. A simple example would be if you own property with no mortgage, you will still be paying for utilities, property tax, and maintenance, which is money taken out of your pocket, in that case making the property a liability until you decide to sell it at a profit and reap its capital gains. An income statement, also known as the income and expenditure statement or the profit and loss statement, is a summary of the income your business earns and the expenditure made within the recorded period you want to review. A balance sheet shows the solvency of your business, and a cash flow statement shows the liquidity of your business. All businesses have to prepare an income statement as part of the annual accounts, which can be prepared at any stage during the financial year. Let us look at some important terms in an income statement. The first term is sales figure, which shows the actual sales for a period without VAT. It also does not include cash received from customers, since there may be outstanding accounts. Matching costs against revenues generated is a principle in accounting. It is crucial to calculate sales figure correctly, which is the sum of all invoices generated rather than invoices paid during the period. Direct costs are directly attributable to the sales which reflect the raw materials, and sub-control costs in the product or service. In most businesses besides retail, the employee can be directly attributed to the product sold. At times, you might consume raw materials that were bought in a previous period. In this case, the cost of materials will be linked to the direct cost. Material that is purchased but is not consumed will reflect in the stock figure in the balance sheet. In most cases, a business does not prepare the accounts until all the bills have been received. But if they have to produce management accounts, then an estimate of the cost is made in order to give a profit figure that is as accurate as possible. Direct costs are deducted from sales figures to get gross profit, which allows a business to calculate the gross profit margin. Overheads are deducted from gross profit to give net profit. It is important to pay attention to both the gross profit margin and the net profit margin. Drastic reductions are a sign of trouble. Depreciation is an element in the income statement that does not involve a movement in cash. It is included to cover wear and tear of fixed assets. If depreciation is high relative to payroll costs, the business is capital intensive. If the payroll costs are high relative to depreciation, the business is labor intensive. Appropriation account is at the bottom of an income statement to explain how profits are divided. Profit can be divided in three ways, either to shareholders or owners as dividends or drawings, to the government as tax, or it is retained in the business to be used as working capital or to buy equipment and other assets. An income statement can address the concern regarding excessive overhead charges. It is useful to refer to the income statement to get a breakdown of each type of expense. When you draw up an income statement, you can see whether you need to take corrective action in order to maximize profit. Income is all payments made to your business from customers as well as money acquired from the sale of products. Expenses are the money that leaves the business for account payment and the purchasing of resources. Sales reflect all the products sold within a specific time period, and cost of sales reflect all the resources needed to make the products that are being sold. We have reached the end of our fourth session. I hope it was easy to understand. Let us take a break and continue in the next session.